Let's turn back to our question of the day. Will earnings disappoint? Joining us now is Dana Dioria, co-CIO at Envestnet. Dana, what do you think?
Hi, thanks for having me. So look, we are definitely moving into a period of greater volatility. I think companies that have been able to pass on costs, inflationary costs, or absorb them with greater productivity, we're going to now start to see maybe some margin pressure. So I wouldn't say that I necessarily expect a bad earnings season, but I do think that the market has to be prepared for more volatility, hits on growth that are coming from these very high energy prices, more supply shocks now, et cetera.
Dana, the idea has been that equities are an inflation hedge. Will this earnings season prove or disprove that idea?
Equities are an inflation hedge over the long term, right? It's not that they're so well correlated in the short run. So we could have a very disappointing earnings season and you'd still say, well, if I'm invested for 5-10 years, I'm still going to stick with equities because equities can pass on these higher costs to consumers. I would say to you that small caps in particular, small value, have been able to pass on costs over time and beat inflation in decade after decade. So that's one place to look. But yes, there's still an inflation hedge if you're looking for the long term. If you're looking for short term, you're unfortunately in an area like TIPS if you want true unexpected inflation hedging.
Well, and of course, those real yields are going ever higher. We're only negative by about 17 basis points or so right now. Dana, how problematic is that?
So, and I'm sorry, which part of it? I didn't catch the beginning part of your question.
You're seeing real yields that are increasingly less negative.
Yes.
We're only 17 basis points away right now from positive territory. And I'm wondering if and when we get to positive territory, how problematic that is for the equity market as a whole.
Yeah, no, real yields have been a problem for a significant period of time. I think, look, we have a period now where equities and fixed income are struggling in this market. And we're going to be, for the foreseeable future, looking at not only volatility in the equity markets, but also potentially lackluster returns in fixed income. So I do think it's a problem for the market. I think the market has a lot to contend with in terms of, obviously, geopolitical crisis. Midterm election is generally a more difficult period of time, right? After the midterms, markets tend to pick up. So I think if you can kind of stick with it, there's an upside at the other side of this.
What are we going to learn about the consumer this earnings season, do you think, Dana? Obviously, a lot of people are starting to feel quite stressed about what they see at the grocery store and at the gas station. Is that going to be reflected here, do you think?
Yeah, I think it's been interesting with consumers because they seem to have keep continuing to show up in spite of the fact that we keep reading consumer confidence is down. Inflation is the #1 concern for everyone, right? Far surpassing, obviously, employment, which is, we have a very tight employment market. So it's hard to say if we're going to actually see a drop off at this point in purchases. Now, one thing that works against and suggests maybe we could is that that cushion that everybody developed, that liquidity cushion and savings, is really starting to diminish. During COVID, because of all the COVID checks, American households had a lot of money on hand. That's starting to diminish significantly.
Well, and if that potentially is going to ultimately start to weigh on demand, have we already seen the limits of companies' pricing power? Is this the peak?
Oh, no. I mean, look, I think actually the good news about what happened during COVID is that we saw great productivity increases and margins were pretty robust. I do think that companies will be continuing to pass on these costs, that we're going to see more of it. It's going to hurt both margins as well as continuing. I mean, what we've seen in inflation is that it's actually very broad, right? We're very focused on food and energy, but inflation at this point is pretty broad across the different sectors that are looked at. So I don't think that we have.
Dana, companies are going to have to pay more for input costs. They're going to have to pay more for labor. The middle of the P&L is going to be stressed. Margins are going to come under pressure. Where does that leave buybacks? How much spare capacity is there going to be from the US corporates to continue to buy back their own stock? That's been a huge driver over the last few years in terms of the stock improvements that we've been seeing.
Yeah, it's a great question. I was just looking at a company, I won't name names, but that is now rethinking a planned buyback, because of labor costs and other issues. So, I do think we could see an impact on buybacks for sure. Interestingly, I think, dividend payers is probably a place where clients and investors might want to look as well. I mean, we've gone into this stage where dividends don't matter as much. Now we focus on buybacks in a lot of cases on how to return money to investors. But, as we move into a phase where we're returning to fundamentals, higher interest rates, I think the impact of having just a lower duration in your stocks, right? So instead of being very heavy in growthy stocks where the terminal value is where a lot of the value is, and you have to kind of wait for that growth to appear. I think dividend payers is a place where people are more going to look because it is lower duration in terms of getting some payback, and you're not as stuck with the vagaries of whether the buyback actually happens.
Final question, Dana, since the banks are on deck next week, how do you feel about the financials going into this earnings season, considering they've been pretty beaten down?
It's odd, right? Because we're in this rising interest rate environment. We have a very hawkish Fed telling us that the interest rates will keep rising. I think what we're seeing with the banks is recession signs are kind of hurting them. So we're seeing this rotation to defensives, away from banks, away from risk on, semis and into places like utilities. And even though the curve would suggest that banks have a way to make out on this, I think because of concerns about recession, you're going to continue to see that defensive rotation.
It's interesting. The housing market continuing obviously to be very strong here and now, yet the house builders are starting to be priced lower on the expectation, as you say, maybe of this coming recession. Dana, it's been great to catch up. Have a great weekend. Really appreciate you joining us this Friday. Dana Dioria of Envestnet. Thank you very much indeed. What are we going to do next? The leaders of the United Kingdom and Germany meeting today in London to discuss the war in Ukraine and the response to it. The live shot has just come up at 10 Downing Street. We are anticipating a press conference at some point. Boris and Olaf speaking soon. This is Bloomberg.